where I think people will run the risk of being, you know, serfs, digital serfs to this thing really comes down to not doing self custody, right? Like not having control over your own keys and being economically reliant on the state, right? So if your job gets automated away, you don't have any other alternative means of employment, you haven't retrained your skills, or you haven't planned for that possibility, and you end up on UBI, then that's when you're sort of ensnared within the system. And those are the two big things.
Hello and welcome back to Collapse Life. I'm your host, Zara Sethna. Today, we're digging into the surge of interest in stablecoins, what they are, how they differ from Bitcoin and other cryptocurrencies, and whether the Genius Act is a turning point for digital finance here in the US and beyond. But before we get to that, please take a quick second to hit those like and subscribe buttons. That will make a huge difference for us. Returning to the podcast today is our favorite cryptocurrency guru, the Bitcoin capitalist, Mark Jeftovic, founder of bombthrower.com. We'll be exploring all the talk about convenience and innovation, the concerns around centralization and surveillance, and how all of this fits into a bigger picture of monetary control, financial sovereignty, and technocracy. So, Mark, it is so great to have you back on the show. Welcome.
Hi, Zara. It's always great to be here. Thanks.
Thank you. And I know you're a very busy man, and this is something that you think about a lot. So we're really grateful that you take in just a small piece of your day to talk about these things with us. So I wanted to maybe just start for those who are maybe hearing the term recently for the first time, talk a little bit about what stablecoins are and how they differ from traditional cryptocurrencies like Bitcoin, not just on the technical front, but also on the philosophical front. How do they differ?
Sure. I suppose the easiest way to differentiate is Bitcoin and then the rest of the cryptos that came later were put forth as like an alternative to fiat, and by fiat currency, we mean dollars, which are already digital anyway in a large sense, but just paper dollars, digital dollars. But the central banks of the world just print them out of nothing. Right. They get created, not just central banks, but even money center banks. And it's not just dollars. Pretty well every national currency in the world is a fiat currency, going back to I think the Latin word by decree, right? So it's just like, this is now money, and you print it out of thin air, and people exchange it for value and work to earn it. And so Bitcoin, the original cryptocurrency, although it hates being called a cryptocurrency, but it's a category of one. And it came along and said, well, there's a way to do digital scarcity. There's a way to do a cryptocurrency where we can just bake in a hard cap, so you can't just make this stuff out of thin air. Mm-hmm. And in Bitcoin's case, it gets created through, a very computationally intense process called mining. Mm-hmm. And the algorithm for it, it's, we won't get into the weed with the math behind it, but it comes down to a lot of computers around the world trying to solve a math problem, and every 10 minutes it happens, and then some new Bitcoin comes into existence and appended to the blockchain. But there's no way to accelerate that. Like, you can't create more Bitcoin than the block reward, and you can't go past 21 million, which is the hard cap on Bitcoin. Right. And then after that, a lot of other things came along: Ethereum, Solana, Monero, all of these things. And they all did their own sort of variations on it. Ethereum essentially has no hard cap. There can be infinity Ethereum. They claim that it's a deflationary cryptocurrency, and it goes through periods where the supply goes down. But overall, there's this, you can get to infinity with Ethereum without violating any of the rules. So nothing's really in that same camp as Bitcoin. But they were sort of set up as this alternative to the monetary system we have today. And also beyond the inflation risks, there's There's the capital control risk and the confiscation risk and the self-custody ability where nobody can take your wealth away from you. Um,
Right.
you can memorize your seed phrase, have 12 words, 12 or 24 words memorized, and you can just carry it in your head wherever you go.
Mhm.
And that's quite empowering. You can move billions of dollars around the world in a few seconds. It costs pennies to do it, which is a big uh, that sets it off. It sets it apart from other hard assets like gold, which I also like. Different reasons, different options, but gold is hard to move. Right?
Right.
It's if you have a lot of your wealth in gold, it is not. You can't just beam it around the world at the speed of light as fast as you can think it. It just doesn't work like that. It's heavy and it's
Right.
hard to move. Uh, then there's you come back to the dollar system. The US dollar is the world reserve currency. Pretty well everything is benchmarked to the world reserve currency, and the world reserve currency is nothing backed by debt, really. And it's just it's actually in its own way meets the stereotypical definition of a Ponzi more than any crypto ever did. And then before the recent developments, there were these things called stable coins. And they
Mhm.
were kind of in this regulatory, I won't say gray area because they were permitted, but there was all kinds of headwinds against it. Excuse me. In the United States, the previous administration, the SEC under Gensler, the Biden administration, of course, you had Liz Warren and her anti crypto army. She kind of thought of everything in the digital asset space as crypto and evil.
Hmm.
And stable coins were kind of like they're sort of a crypto, but they're more accurately thought of as a digital representation of a fiat dollar.
Right.
So there's no real hard limit to the amount of stable coins that can exist in the world. If there's enough T bills to back them, you can create stable coins. And so the sort of hedgehog concept behind a stable coin is that in order for a stable coin to be minted into reality, it has to be backed one to one by a dollar asset for a
Mhm.
US dollar pegged stable coin. And 99% of the stable coins in the world are US pegged stable coins. There are some euro ones. As far as I know, I haven't looked in a while, but there is no Canadian loonie stable coin that I'm aware of. So most of them are US dollars. There's Tether, which has always been under a cloud of its own controversy because they're a little opaque in reporting their reserves. They're always accused of minting new tethers without having one to one backing.
Mhm.
There's Circle, which just had one of the most successful IPOs in history. They went public a couple months ago. I think they're already, I don't know, a $60 billion market cap. I'd have to look up the number to be sure. They're the second largest stable coin. But the thing about Circle is they're publicly traded, they're regulated by the SEC, and they publish their reserves right down to individual CUSP IDs on the tranches of T bills that they hold in their reserves. So there's no cloud hanging over Circle as to whether they're fully backed or not. There's another thing called algorithmic stablecoins that might take us a little into the weeds, but
Yeah.
the TLDR on that it was a failure of an algorithmic stablecoin that caused that set off the whole crypto winter of 2022. Uh, but suffice it to say, the purpose of a stablecoin, and sorry to go on at length at this, but the point of a stablecoin is to sort of provide this bridge from fiat world into the crypto world. And so in the olden days, you wanted, let's say you were a private equity firm or a family office or like someone with a lot of money. And you want to allocate $10 million to Bitcoin. Well, how do you get there, right? Do you go to mountgox.com and fill out the form and like take a selfie with your passport and send it in?
Mhm.
Or do you go to the institutional desk at a place like Circle or Tether and say like, okay, we're going to wire you $10 million and you're going to issue us 10 million Circle, like USDC or USDT. Now we're in the crypto ecosystem. Now we can move this around at the speed of light because we're already in the digital asset space. And the second benefit of it was you had this liquidity now. So if you were sitting in Ethereum or Bitcoin or any of these other cryptos, and you wanted to take some profits off the table, you wanted to guard against some downside protection, you could move it into stable coin without pulling your assets all the way out of the digital economy, withdrawing it from the exchanges and waiting 3 days for them to wire it to your bank account. It was like it provided a way to sort of go to cash very quickly and stay in cash, but still be out there in the crypto world.
Okay.
The last thing I'll say, and then I'll let you talk, sorry. The thing about stable coins is how they differentiate from, say, Bitcoin or Ethereum. Bitcoin and Ethereum and Solana, they're all their own layer one, like they're their own layer one blockchain. Whereas a stable coin like Tether or Circle runs as a token on those layer ones. So you can have Circle that's sitting on Ethereum, or it's sitting on Solana, or it's sitting on Bitcoin via Lightning. Actually, Circle's not on Lightning, but Tether is. And so these stable coins are not really tied to a blockchain the way Bitcoin is. And, there's no scarcity and there's no self-custody other than the self-custody of the private key that controls that wallet address. So they're more of a digital extension of a fiat dollar than they are a cryptocurrency unto themselves.
That's exactly what I was just going to ask you. It sounds like originally the cryptocurrency space was designed as an alternative to fiat currency, and stablecoins sound like a digital extension of what's in my bank account currently. Is that correct?
Exactly. And it's not a surprise that there's been this complete regulatory flip on them either. And not just because, the one side is out and the other side is in, and they have automatically opposing views on everything. But I think there's been this sort of realpolitik, pragmatic view of, we run the world's reserve currency. We're running up every 100 days, we're racking up another $1 trillion in debt.
Right.
Our debt is getting harder to sell. Bond yields are going up. Japan's not buying our dollars as much anymore. China's certainly not buying our dollars anymore. We need another buyer. We need another outlet for this. So if we suddenly reset the table so that crypto companies and fintech companies aren't like hunted and persecuted, but actually promoted and elevated, then they're going to suck up all this liquidity of all this debt, because people are going to want to allocate to this new, deregulated space. And to get into it, you're going to have to go into stable coins. And then from stable coins, you can get into the asset space. So in a sense, for Bitcoin to succeed, but especially for everything else out there in crypto land to succeed, there had to be this better intermediary layer. So stable coins are it. And I think unto themselves, they're not terribly controversial. They're kind of inevitable. But where it starts to get strange or sort of complex, or you have to really sort of look at what's happening, is there's a third category that I've been watching for years called central bank digital currencies.
Right.
And, Donald Trump campaigned on no CBDCs and he got elected. And there's even some federal and state laws against CBDCs. But when you think about the things that CBDCs, central bank digital currencies, set out to accomplish or had the potential to impose, like expiry dates on cash, conditional programmatic spending on cash, like almost like a bootstrap of a social credit system, you can piggyback all those functionalities on stable coins, right? And cryptos themselves. So there's this strange Venn diagram of like crypto, and I'd say even Bitcoin is a circle a little outside of the crypto circle because it's sort of in a category of its own. Then there's stable coins, and then there's CBDCs, and they sort of all overlap with each other. That's the world we live in now, and it's complex, and they have these weird interplays, and you just have to it's going to be an art and a science unto itself to navigate your wealth in that Venn diagram to sort of keep it out of harm's way.
Yeah. What you just said about the CBDCs, I think, is the main concern of people like you and others who are watching this space and saying, okay, so the government has announced no CBDCs, but couldn't stablecoins just be the Trojan horse to bring in CBDCs, and just call them by something else so that we think
Yeah.
it's actually a positive when the real fears are still inherently there. So is there still a meaningful line between the two? Does the Genius Act do anything to keep them on separate tracks, or are we just seeing the rollout of a CBDC in another name?
It's not a CBDC yet, right? And the thing is, the thing about CBDCs, unto themselves, they're not even particularly scary, right? Until they turn into the social credit kind of aspects. Um, and there's actually, we should actually also clarify, there's what's called a wholesale CBDC and a retail CBDC. And the context of what you and I are talking about, this is all retail CBDC. This is customer facing, like
Right.
I get it on my phone, you have it on your phone. If there's universal basic income, it's going to be implemented through a CBDC. It's going to happen on the phone. Wholesale CBDC is really an interbank clearing network for banks and sovereign central banks and big institutional players behind the scenes to move money around, which is a bit more liquid and fluid than the existing ACH and wire systems. Because I don't know how often you send wires. I send wires a lot. It's like, it's archaic, it's stone age, it's, you don't know where the money is, it takes days, like it's really like, voodoo, really.
Hmm.
So there's already wholesale CBDC systems. In fact, the US launched FedNow in 2023, which is the federal wholesale CBDC. And it launched, interestingly enough, just a couple of months after the regional banking crisis of 2023. And why that's interesting is because the regional banking crisis, that's when Silicon Valley Bank and Signature Bank and Silvergate got sort of whacked before the regional banking crisis. And some argue that it set it off, but it happened in astonishing speed, and it was a larger crisis than the global financial crisis of 2008 and 9. Like, not a lot of people are aware of it, but it was the largest bank failures ever, like compared to that. And it happened, the GFC played out. I mean, the early rumblings of it were like 2006. There was that failed Bear Stearns auction. 2007, things are like, people were sort of getting funny feelings about this. In 2008, it all sort of breaks loose.
Mm-hmm.
The equivalent in 2023 was, Silvergate got whacked by Liz Warren, and then it kind of got a little weird. And all this played out in weeks. And then when SVB, Silicon Valley Bank, went bankrupt, it happened in like 12 hours, right? Because it was banking all these Silicon Valley bros. They're all walking around with their corporate treasuries on their cell phones, and they're all like fleeing their money out at like 6 o'clock on a Friday afternoon. They're moving like billions of dollars out of SVB. And so it collapsed in 12 hours.
Mm-hmm.
Now, fast forward 4 months after that, FedNow launches. Okay. 12 hours is slow now. Now you have the mechanism to create a bank run at like 2 minutes to midnight on Saturday night on a long weekend. And that same bank run that was astonishingly fast in March of 2023 can now happen in about 45 seconds
Hmm.
today. So, in a way, this launch of the wholesale CBDCs by the Fed now, and there's a few in Europe already. It's almost an own goal because they've created a way to create systemic risk at light speed. So I always say wholesale CBDCs present enormous existential risk to the banks, and retail CBDCs present enormous existential risks to the citizens. And so you've
Right.
got these two sort of things that makes the Venn diagram even more complicated.
Yes. And it is so complicated I mean, already the banking system is pretty opaque and difficult to navigate. And this just feels like it adds more layers of complexity. And we need folks like you to help us decode what's going on. What does that mean for, let's say, the boomer generation that's aging and already struggling to just kind of figure these pieces out and protect what they have of their assets? How are they going to be able to navigate through this world?
Oh, that's an excellent question. I mean, it really depends. I mean, I know boomers who are like so technologically hip, they're all over this stuff and they've got Bitcoin and cold wallets and they're day trading cryptos. But for the most part, that's probably where you're going to see these fintech products addressed to the boomer crowd, the sort of older generation where it's like, okay, let's say you want to protect your wealth through Bitcoin, but you don't want to learn how to like air gap a coin kite, right? A cold card. So just buy the BlackRock IBIT ETF. And now
Hmm.
you're protected because you have your wealth in Bitcoin. And what people don't realize, if you don't really look at it, is there's a big difference between, Bitcoin TM, as Ben Hunt calls it, and Bitcoin, like the
Hmm.
actual stuff on a cold wallet, self custody, or with institutional multi sig or something like that. But I think the boomers are either just oblivious to this and they're close enough to the end of the road, they're far enough down their glide path, it's not really going to impact them too much, or they will just make use of these new fintech products to sort of try and capture that protection or upside. Where the real risk is at the other end of the curve, right? The millennials, the Gen Zs, the younger people who are like, I mean, they're born into this world, right?
Right.
So they were born into surveillance capitalism. They don't know anything different. They're used to just everything they're doing being tracked and monitored and throttled and stuff. And so that's already baked into their whole worldview.
Hmm.
And they have to take action to sort of understand the value prop of like a Bitcoin, and a lot do. So to their credit, there's a lot of young Bitcoiners, there's a lot of young crypto people, and there's big chunks of that generation that get it, but they're the ones that are facing the most enormous risk because they're the ones who have a whole career in front of them with a job market completely transformed by AI. They're the ones that are going to be probably living in a world with UBI. And I
Hmm.
always say UBI is going to be CBDCs and it's going to be social credit. And so
Hmm. Hmm.
they're the ones headed into that world. The boomers kind of missed that world, right? And then anyone in between, I'm not a boomer. I'm just outside of that generation, but I've got enough years in front of me that it's like, yeah, I could see myself facing these risks as well.
Right. Let's talk about that Gen Z for a second, because as you said, this is a generation of people who were never cut a paper paycheck and had to take it to the bank and countersign it. They never, use those little checkbooks to kind of balance their accounts. Everything has been physical. They probably don't use cash very much. They pay for everything with QR codes. They use Venmo and Klarna and all of these things.
Yeah,
So this is a world that they understand. So if you layer in stable coins to that, what's the difference? They're already using full
exactly.
digital forms of payment. Stable coin is just another way of calling the world that they live in anyway, isn't it? Is there a difference?
It's just another icon on their phone. Really, it's like, oh, I don't have to log into my Royal Bank account to move money to so and so Scotia Bank account. It's just like, no, I'm going to open my Bread wallet and I'm going to, well, now it's Coinbase wallet. I'm going to open my Coinbase wallet and send it to so and so who's using Phantom, right? So to them, it's just another app. It's just another icon.
And do you need to have a Royal Bank account or a Scotiabank account anymore at all? Or do you just hold it in these stablecoin apps?
That's a really, really good question. You're going to see this big transformation. So, this is the big disruption that I think was causing this existential panic, let's say before the Trump administration. And here in we can talk about that separately. Canada has been such a mixed bag in terms of our crypto posture, right? Like we had spot ETFs here like years before they were a thing in the States. It's like,
Mm-hmm.
what's the big deal? They're already here. Like, who cares? But, you know, but at the same time, you can still get debanked in Canada for even having the word Bitcoin in your business address. It's crazy. So, but, the banks had this excess, I think, awareness that it's like, what's anyone going to need us for?
Right.
Now, what we're seeing is, huge companies like Amazon and Walmart and PayPal saying we're going to just issue our own stable coins.
Mm-hmm.
Coinbase already issues their own stable coins. And so one of the things I tell my readers, and the reason we hold certain stocks in the Bitcoin capitalist portfolio, is I say, here's a picture of all the bank logos of like the year 2000, right? Chemical Bank, Citibank, Bank of America, whatever. And then I show another picture and the icons are like Coinbase, MicroStrategy, Marathon Digital, Circle. It's like, this is that same picture 10 years from now. So
Mm-hmm.
this is where banking is going. And I think what happens is these banks, if they're aware of it, they understand that they are in the process of almost being disintermediated out of this value chain. They make their money issuing loans, so maybe they will still do that, but they will probably start issuing their own stable coins, or they will create consortiums with networks of stable coins together, or they turn around and they try to buy these fintech companies and merge into them,
Mm-hmm.
right? But that's really what's happening, is they're sort of being eaten from the ground up. Um, as crazy as that sounds.
Right. So the Genius Act, which was just passed into law here in the US in July, allows for regulated financial entities to issue stablecoins. So was that put into place for just that very reason, so that
Give them a
banks
Yeah, give them
have,
a
yeah,
bone and give them a survival line to say, okay, this is how you can stay relevant.
right. Now, Um, and that's also so to say that you or I cannot create stable coins the way you could mine a cryptocurrency. It can only be these regulated entities. Is that
You,
correct?
you can create a stable coin. You could create an algorithmic stable coin, which we mentioned earlier, but you're not going to be within this regulatory framework.
Uh-huh.
So let's say you issue these things, you're probably going to be under heightened scrutiny from the SEC. You're not going to be able to use your assets as collateral in loans the way a regulated stablecoin issuer could. Um,
Okay.
so you would exist outside the tent, so to speak.
Right. And you've mentioned some major corporations who are saying, okay, we can issue our own stablecoins, PayPal, Amazon, things like that. So how will small banks and credit unions fare within this? I mean, credit unions that can barely keep up with managing their customers' credit cards. Like, is there a leap there? Will they just go extinct pretty soon?
They the ones who are agile need not go extinct. They can probably adapt themselves to this, to say like, hey, you know what, you can now deposit your stable coins here. And so they open themselves up to sort of be conduits for stable coins. And then what I probably see happening is a kind of federation or network or alliance of state, like, I don't know, like, what's the word? The cooperators, travelers checks or something, right? Like something like that for stable coins where
Right.
they might, and it'll probably be like someone like Coinbase saying, hey, you know what? If you're a small credit union and you want to be able to be in this stablecoin business, then we will white label our infrastructure to you and you can sort of, and we'll just backstop the whole thing the way they do
Hmm.
with the ETFs. And I can see it happening that way.
So it's sounding a lot like additional layers of complexity that are maybe happening behind the scenes that you and I, or me, so especially, don't see or understand, but also additional centralization. And one of the major kind of perks of cryptocurrencies, as they describe themselves, was decentralization. So are we seeing um, cryptocurrencies now coming up as a better alternative because they continue to be a decentralized space, or what's happening on that kind of dynamic?
Well, it's going to be both. And the thing, when crypto was still in the early innings, when it was still like, is this stuff going to make it or not? I used to always lament, people don't want financial sovereignty. They want PayPal with a number that goes up. They want that ease of use. And so
Mhm.
now we're going to have these stable coins. We're going to have tokenized crypto. We're going to have crypto in these DeFi and like banking intermediary applications. You're going to have the ETFs. And so you have that ease of use. It's like, yeah, we have the ease of use, but you know what? Not your keys, not your coins. Like in a systemic crisis, like a lot of people would get rugged. And then the people who understand this and say, like, yeah, that's all great. I can maybe have some investments in that space, but my nest egg, my wealth, my retained earnings, that's all got to be outside of that blast radius, right? It's got to be
Mm.
self-custodied. And there's a that level of self-responsibility, either like institutionally or corporately or as a family or as a tribe, that takes a quantum leap. Yeah, it takes a lot of work. Uh, the people who are willing to put in that work will be in a much better financial position when these liquidity events inevitably happen.
Um, could stablecoins actually accelerate the collapse of fiat by making it easier to offload bad money?
Uh, you know, it's a similar dynamic to what I was talking about with the wholesale CBDCs, that it makes it easier for a contagion to spread because it can
Mm.
happen at the speed of light. The same thing could happen with stable coins, and we've seen it happen a couple of times where a stable coin will break its peg, right? So that's the equivalent of a banking crisis in a stable coin. In fact, when a nice microcosm of what you're talking about happened during the regional banking crisis when SVB went bankrupt, Circle lost its peg. So it's supposed to be, if you look at them all day long on CoinGecko and you look at Circle and Tether and DAI is an algorithmic one and all of these different stable coins, they're never exactly a dollar, right? They're like 99.5 cents or dollar, a little over a dollar. They kind of hover around that
Right.
parity. And that's just big, big amounts of money sloshing in and out of the system and just sort of covering that spread. So they're always like roughly a dollar. Suddenly, Silicon Valley Bank goes bankrupt, and the Circle had like 3% of its reserves there. So not a huge amount of money, but 3% of the outstanding Circle was trapped in Silicon Valley Bank. And you know how things tend to get dumbed down. That suddenly, I started getting emails from other services that I sort of keep an eye on, and it's like, sell your Circle right now. Circle's lost its peg. Circle is going bankrupt, and it went down to 72 cents or 80. So it lost almost 30% of its value
Right.
because it was a panic. And it happened like that, like it happened in a few hours. Um, I was actually buying at that point because it's like, I kind of understood that Circle was not in any trouble. It just
Mm.
had like a very small amount of its capital trapped in SVB, which was
Mhm.
probably going to get bailed out by the end of the weekend anyway.
It had
So
a
it's,
bad day.
yeah, so it's like we can buy dollars for 70 cents right now, literally.
Right.
Um,
Why wouldn't you?
why not? Yeah, do that all day long. I'll admit, so I tried to lever up to really capture the thing, and I had a really good thing going, and then I got wiped in one bad candle because I was just levered like 50 to 1 on the deal. So it was like,
Mm.
okay, it was a good effort, but I got too aggressive on it. But that kind of thing, yes, you see this in crypto, especially like when Terra Luna happened, which set off the whole 2022 crypto winter. That that was breaking a peg, and I'm laughing now because I remember Raoul Paul, who a lot of Bitcoiners loathe, but I actually like a lot of his stuff. I think he's not wrong about a lot of stuff. But he went on Bankless at the beginning. There was rumblings of this crisis within the Terra Luna ecosystem, and they started the show, and they're like, "Oh yeah, uh, Terra's or Luna's lost." Yeah, Luna's lost its peg. It's like at 92 cents right now. And then they're talking. 20 minutes later, one of the hosts says, "Oh, guess what? Guess what it's at now?" And Raul is like, "I don't know what." And he's like, 62 cents. And the look on his face, it's like a meme right there, like just the guy's face just almost imploding live on a podcast because it had lost, he realized that that was like, $100 billion in value in the 15 minutes that they had been talking. Like, and then of course there is all these knock-on effects. So this was just steamrolling across. And if you've ever been in a crypto crash, like there's nothing like it. Bitcoiners tend to do it with aplomb. We have a lot of fun during crashes if we're holding our crypto right. But
Mhm.
um, it happens like greased lightning
Wow.
when all this stuff comes unglued. It's I mean, it can be terrifying if you're wrong footed, but I mean, the last story about it. I'm having lunch with Joey from the Canadian Bitcoiners conference last August 5th when Japan did that surprise rate hike,
Hmm.
and they set off that contagion across the entire world. Well, they did that on the Friday, and on Saturday and Sunday, the only markets that were open were crypto. So they were reacting to all this first. And we were just joking. We were looking at Ethereum, and it was dropping like from the time we ordered our appetizer to the time they showed up, like Ethereum lost 25% of its value, and Bitcoin was down 15%. It was just like, it was crazy. So
So you've already described how stablecoins could potentially be an on ramp to a programmable, surveyable money system in the future. And that future could be very short around the corner. Is there a way for anyone who's wary to opt out of the system, or is tokenized, traceable um, future just locked in?
So there's a couple of different things that you're talking about there. So
Okay.
traceable, like everything is traceable in crypto land because everything on a blockchain is completely transparent, with the exception of, let's say, Monero, right? Which is sort of the ugly stepchild of crypto that nobody wants to talk about, but it's out there, and it's purely anonymous. There's a few others like Dash, and I don't even know if Zcash is still going. The Zcash people are going to kill me if they hear me say that. But things like that, the specific privacy built coins. Um, the Where I think people will run the risk of being, you know, digital serfs to this thing, really comes down to not doing self custody, right? Like not having control over your own keys, and being economically reliant on the state.
Right.
right? So if your job gets automated away, you don't have any other alternative means of employment, you haven't retrained your skills, or you haven't planned for that possibility, and you end up on UBI, then that's when you're sort of ensnared within the system.
Hmm.
And those are the two big things.
Right. And so if that is, and it sounds like a pretty inevitable picture, if that is the future we're moving into, um, one way to kind of protect from that is, as you said, self custody. How does precious metals fit into that?
Yeah, I mean, there's always going to be a place for precious metals, but again, they're hard to move, right?
Hmm.
So if you're sitting here where I am in Toronto, and suddenly, Mark Carney declares, another state of emergency, and I want to seize close everyone's bank accounts because they said something I didn't like. I can get out of Dodge if I think it's going to last longer than the last one did, and recover my digital assets in some other place. But I'd probably have to leave the gold where it is
Hmm.
because I can't just get there and move it fast. But in a different scenario, like I always say, crypto and Bitcoin and gold, they give you different options in different scenarios, right? And
Right.
I think the big one is really a global hyperinflation or a high inflation across all fiat currencies. Even doesn't matter if you're tied to a stable coin. If you're printing too much of the stuff, your purchasing power is going to go through the floor. So things like gold and silver, you'll be able to buy an investment property with your
Mm.
gold, or do some sort of deal like that, provided that the overall scaffolding of society is more or less intact still.
Right. Um, this is probably going to sound silly, but what if there is some sort of complete grid down scenario? How do you access your crypto and digital holdings if you can't access the internet?
Well, that kind of a scenario probably localized, right? So you don't until you're either in an area where there's electricity, or the grid comes back up. The Bitcoin blockchain, it's on satellites now, so
Okay.
you know people then say, well, what if it's a complete catastrophic grid down across the entire world and it's not coming back up? Then you don't really give a shit about your Bitcoin, because it's all about guns, ammo, and cans of tuna at that point.
Mark, it's such a pleasure talking to you as always. What are you watching over the next short period of time? Maybe now till the end of the year. What do you think we're going to be seeing?
So I'm it's really incredible what's happening with US interest rates and bond yields across the world. So I've been writing about this every month in the newsletter. Ever since the Fed panicked in September and did that half point rate cut, bond yields have been going the wrong direction, right? Not just in the US, but practically everywhere. And yet, this is the kind of thing that financial commentators, other than myself, like including myself, but like I didn't invent this notion that the central bankers have painted themselves into a corner. There's too much debt in the world. Interest rates should be much higher, but they can't because there's too much debt, and they can't lower them because it's going to run away inflation. And
Right.
inflation is not contained. Like they keep the talking heads keep saying inflation is contained, but anybody who's living in the real world, heating their homes, feeding their families, they know that inflation is anything but contained. So
Mm.
they're really screwed. They don't have a move, but they have to do something. And so the Fed will cut probably in September now. And inflation, England, the Bank of England just cut like a couple weeks ago. Like we're heading into this high inflation thing that gold bugs have been prattling on about for 40 years. And they were right. It just took longer. And the Bitcoin guys have been saying it all along. And I've been saying It's kind of interesting because I said in my crypto capitalist manifesto, like gold and Bitcoin will have multi-decade tailwinds from a bond exodus, because bonds are just these tokens of this dead money that's like going to zero. And there's $300 trillion in bonds right now, and that's held by like big money, right? Not retail. It's held by family offices, hedge funds, private equity, sovereigns, and they're like, one way or the other, they're all going to start edging for the door, but doing it in a way that doesn't cause a panic. So
Mm.
my theory, not just to the end of the year, but years out from now as well, is that Bitcoin is the new benchmark. So it used to be like the US 10-year was the benchmark. It was called the risk-free rate of return. And then a guy named Lacey Hunt came up with the clever, bonds are now return-free risk, right? That's what they are. They flipped. And I think so Bitcoin becomes the new benchmark. And we see these with the Bitcoin treasury companies. You see Michael Saylor saw it before a lot of people, and he just went out and said, I want to buy as much Bitcoin as possible, even levering up to do it. We've talked about Hugo Steins on an earlier show of yours.
Yeah.
Companies and allocators and big institutional funds are going to just look at their wealth and their capital allocation decisions and say, if we can't beat the Bitcoin rate of return, call it 25% over 4 or 5 years, compounded annually, then we're just going to buy Bitcoin, right? And you see that with the Bitcoin treasury plays. You see other companies trying it with other cryptos. The economics aren't there to work. Those are not going to work long term, and it's sort of a whole separate conversation on why. So Bitcoin just keeps ratcheting up. I don't even know if the 4-year cycle is intact anymore. Those are always very dangerous words. They're usually uttered towards the end of a cycle and heading into an 80% pullback. But, 80% from where? Sometime. If the 4-year cycle is intact, it's a whole separate conversation as well, what it is, where it comes from. It comes from the Bitcoin halving protocol. But, towards the end of this year, early 2026, I would be looking for a top that would probably be preceded by a parabolic spike from here. So we're already sitting at like 120,000. Where do we go from here? 300,000, 400,000 ish, maybe. And then 80% down from there. If that holds up, brings us to a bottom in the bear market, the next bear market of like somewhere between 80,000 and 100,000. And then the whole thing repeats again for the next halving cycle going into 2028. Or there is no halving cycle anymore. And it's because of institutional, because of ETFs, because of, stable coin flows, then Bitcoin just keeps ratcheting higher 20% a year from now on. And, and it becomes the new benchmark. And then at some point, there's going to be a resetting of the table for a global currency system. And then they put Bitcoin in there as a component, and they put gold in there as a component, and they put whatever else in there.
So for a retail investor who's maybe, John Jane Doe is just kind of waking up and going, ooh, I really have been asleep at the wheel. I need to do something now. Is it too late to make a Bitcoin play?
No, not. It's still early. And I'm glad you asked that, because people look at the price of Bitcoin and they go, oh my God, 120,000. Like, I totally missed the boat. I don't have that kind of money. Well, for starters, you don't need to buy an entire Bitcoin, right? You can put $50 in. You put $50 in now, you're going to be in, like, get off zero is the mantra. Like, just have any amount of Bitcoin that is not zero. But to get an idea of where we are in this historic story of a change from one monetary system to another, you look at the total market cap of Bitcoin, right? So I mentioned earlier, all the bonds in the world, it's like somewhere between 150 trillion to 300 trillion, depending on what you count in there. Money supply M2 in the US is like it just hit an all-time high. No one's commenting on it. It's 22 trillion. Bitcoin is $2 trillion. So you look at that and you kind of go, it's still pretty early. Gold is it's had a fantastic run this year. Gold was around 10 trillion when I started looking at this. It's now 15 trillion, 16 trillion. Silver's not even a trillion, right? And when you look at it that way, it's like, oh, this is still pretty early innings. And so anyone who's starting from zero today actually is in a little bit of an enviable position, because the entire question of, is this stuff here to stay? Is it going to go to zero? Is the government going to ban it? Like all of that uncertainty, that's all gone. Like that's
Right.
off the table. You don't even have to think about that. Now you're in the enviable position of being able to say, how much can I afford to allocate to it?
Mm.
Right? I got this much money. Can I get a higher return than 25% a year compounded annually by doing something else with it? No. Okay, I'm just going to buy Bitcoin.
Mhm.
And then you can get into all kinds of fun things by building up a stash of Bitcoin. You never sell the Bitcoin. You borrow against it in fiat dollars. You buy something like a business or a real estate that you can rent out. And then you use the cash flow to pay down your Bitcoin loan, and then you take your Bitcoin back. As long as these two systems exist beside each other, you can pull the Hugo Stein's playbook until some sort of global reset comes.
Right. Well, that's incredible advice. You mentioned your newsletter, and I'll add an S to that because I think you have multiple newsletters. So remind people how they can find you and sign up for those newsletters and benefit from your incredible expertise.
Sure. So the free letters, bombthrower.com. If you sign up there, you'll get a copy of the Crypto Capitalist Manifesto, which, I put it out in 2021. It holds up. It still does. So you get a copy of that. The CBDC book, you'll get a copy of that when I finally finish it. I kind of paused it because I wanted to see what happened in the US with that. And I think now I have enough information to finish it. It was about 80% done. And if you go to, there's also the Bitcoin Treasury Playbook, or just, send me an email. I'm easy to find.
Mhm.
And I'm just Mark Jeftovic on Twitter.
Super. Well, we're so grateful that you came back. It's always a pleasure talking to you, and I always learn something. So thank you so much, Mark.
Well, it's always great talking to you, and we'll see you next time.
Yeah, absolutely. Thank you so much.
All right, take care.
Well, we've come to the end of another amazing discussion with Mark. We want to thank him for breaking down not just the technology, but the power dynamics behind what we're watching unfold. And we also want to thank you, our viewers, for staying with us. If you are a regular viewer, but you're not yet a subscriber, please fix that right now by clicking the subscribe button. And if you like what you see on this channel, you can help us produce more quality content by going to collapselife.com and becoming a monthly member for just $8 a month. That helps us bring you more great guests like Mark and to research and write articles that we put out each week. You can also make a one time donation to show your support, commitment free, at our Buy Me a Coffee page. No gift is too small. We really appreciate them all. We hope to see all of you back here again next week. And until then, just remember to keep your chin up. It's only collapse. See you soon.